So another means of acquisition is what we call a non-reciprocal transfer. That's a fancy word. So non-reciprocal just means that it's not an even transfer. Like if you're like, oh, I would like you to reciprocate, that means you want to be given what you gave up. And so if we have a non-reciprocal transfer, easier words for them would be like donations, gift, charitable contributions. So we're receiving someone else's charity, someone's donation, right? Or maybe something from the federal government, some sort of a subsidized asset. For these acquisitions, right, we didn't give up anything. There was no assets or consideration, like no note signed that I'm going to have to pay later, given up. So we don't have no fair value of what was given up. If we go back to that, oh, we have to judge it by what is the fair value of what I gave up versus what is the fair value of what I received. Well, I didn't give anything up. So is the appropriate value for the asset zero? No. What we do then is the solution is to use the fair value, or actually we're just defaulting to use the fair value of the asset received. So whatever that amount, whatever that asset is, we look it up, we get a tax appraisal, we establish some way of figuring out the fair value of this item, what we think it's worth. We record it at its fair value. This is the fixed asset, the asset received through donation. It's an easy debit to whatever asset account, debit equipment, debit building, debit fixture. And then we actually just, because we didn't give anything up, the credit is to contributions revenue. This is just net income, right? So it just increases our net income, contributions revenue. I think there's alternate terms for it, but basically we do have a net income movement because we didn't have to give anything up to get this asset. I want to skip the dispositions, the dissolutions for now. What I would rather focus on is exchanging assets for assets, non-monetary exchanges, and just kind of looking through the rules for that. This happens when we exchange assets. We might, we exchange one piece of equipment for another company's piece of equipment. We might exchange some amount of cash or monetary value along to help facilitate the transaction. And so the way we want to record it is to record the new fixed asset at the fair market value of what we gave up, the old asset. So again, it's that what we gave up or the fair market value of the new asset, what we receive. It's the same story, but now we're just judging it instead of based on we're receiving an asset and we're giving up money, or we're receiving an asset and we're signing a note. We're receiving an asset and giving up an asset, but it's still, what's the fair value of what I gave up? Is it the old asset that I'm exchanging, or is it the new asset I'm getting in the exchange? And usually the company has better information on their old asset, the one they've been using, i.e. the one we're giving up. So this usually is the winner in terms of being able to figure out the readily determinable fair value. When we exchange something and we also pay a little bit of money, then we have to adjust what we gave up, because we're not just giving up an asset. Then we're either giving up an asset and being paid some money, or we're giving up the asset and paying extra money. So in the case that you're getting the asset, you're giving the asset up and giving cash up. So giving up the asset and a cash payment. Then all you have to do is add the amount of your cash payment to the old asset's fair market value. And that makes sense because what you're exchanging two things. You're exchanging not just the asset, but you're also paying, for example, $10,000 in cash. So the new asset would be the new acquired asset would be equal to the fair value of the old asset that you're giving up plus any cash paid. If you receive some cash, then this is offsetting some of the value of the asset that you gave up. It's, if someone's paying you cash, you're giving them a car and they're giving you a car and they're paying you cash. Well, then that probably means that the new asset is worth a little bit less than the asset that you gave up. The old asset minus any cash received. If I gave up a car and I knew my old asset was $10,000 and they were like, oh, okay, so we're going to take your asset worth $10,000. We're going to give you an asset plus $1,000. Well, what does that mean about the asset they just gave me? It must mean that they thought they had to bolster the asset they gave me with $1,000 in order to meet the value of my old asset. And so if my old asset's worth 10,000 and I received $1,000 in exchange, then the asset I got must only really be worth about $9,000. And so it makes sense if you think it through, the way that cash is either adding to the value of what I'm acquiring if I had to pay it, or if the cash that I'm receiving indicates that the value of what I'm acquiring really what isn't as much as what I gave up. They had to sweeten the deal by paying me some money. So that's how we calculate the value of the new asset. It's based on the fair value of the old asset in both cases. And then we just adjust it by whether we paid cash in the deal, which would mean that the asset we acquired is worth more than what we gave up in terms of the old asset, or if we receive some cash on this deal, then the new asset that we acquired is worth a little less than the asset that we gave up because we had to receive some money on top of it to make us happy. When we're calculating the gain or loss on this exchange, this is the one time that when you're acquiring something that there's a gain or loss involved. And so this is the exception to recording a gain or loss on acquisition. And part of the reason you're doing that is because you're acquiring this asset by giving up an old asset. And that giving up the old asset part, the old asset is where the gain or the loss is generated from. So this gain or loss is entirely set by the fair value, the fair market value of the old asset and the book value. So you're looking at what the old asset is really worth versus what is it at on your books, right? If the fair value of the asset that you're giving up is less than the book value of the asset that you're giving up, then that means that our books have overstated its value, that when we actually go to exchange it, as we are doing in this exchange of assets, its fair value is less. And so this is a loss on exchange. Our books say it's worth more. We go to enact this transaction and trade assets. We find out that it's not worth 10,000 like we thought it was from our book value. It's only worth 7. So we have to recognize a $3,000 loss on exchange. If you have a loss, you always recognize it and recognize it immediately. If it's the opposite case where you have a fair value that is greater than the amount that is on your books, so its value is actually 13,000, even though you only had it at 10,000 on your books, then you're in the position where you're exchanging on a gain, because we actually understated the value of this asset on my books. And now that I go to exchange it, I recognize the fact that it has more value than it had, than my historical cost minus accumulated depreciation gave it. Right. So when you're recognizing one of these asset for asset exchanges, you the very first step is to recognize whether you have a gain or a loss on exchange. And that is, and again, entirely based on the fair value of the old asset, the one that you're giving up versus the book value of the old asset, and whether the inequality suggests that the book value is greater or the book value is less. If you think about it in terms of, I just usually simplify it to, if I had it on my books at 10,000 and I find out it's really only worth 7, I'm sad. That indicates a loss. If I had it on my books at 10 and I found out it was worth 13 on the market, then I'm happy. That's more of a gain situation. So I'm going to write a real quick example. This is the template of the journal entry. It doesn't make a whole lot of sense though, unless we just have an easy example to set it up with. I mean, it looks really complicated and scary, but it's not that bad, I promise. Let's say that we exchange equipment with a historical cost. So we bought it 5 years ago or whatever at $50,000. And after 5 years now, it has accumulated depreciation of 35,000. And it has, so that is one factor or one fact. And then we'll say that equipment has a fair value that we assessed at 38,000, or yeah, that's a little high. Let me actually do the math in my head real quick. $19,000. And we exchanged that for another piece of equipment. And that's, and let's say that we receive $1,500 cash plus new equipment. All right, so this is the facts of our asset exchange. I'm exchanging my old equipment for new equipment. My equipment has a historical cost of $50,000. It has accumulated depreciation of $35,000. My equipment has a fair value of $19,000. We receive from the company that we're exchanging with $1,500 and their old equipment for this item that I'm giving them. So how do I record this transaction? So like I said, the very first thing I do when I'm working one of these is figure out if there was a gain or a loss on my side. So the book value of this is just its historical cost less its accumulated depreciation. That's how we judge the book value of equipment. Remember, the book value is just the value I find on the balance sheet. 50,000 less 35,000 gives me a $15,000 book value. That's what I would see on my balance sheet. Equipment net, $15,000. That's what I'm giving up. The fair value of this equipment is 19,000. So my books tell me it's worth 15. When I go and do an appraisal and figure out what the true selling price of this equipment is, I come out to 19,000. Now this is enough for me to determine whether I have a gain or loss. In this case, the fair value is greater than the book value. And that makes me a happy person because I have it on my books at 15. It's really worth 19, which indicates that I get a $4,000 gain. Now, with gains, it says to recognize all losses immediately. With gains, we have to have we only recognize in certain situations. And right now, we're just going to assume that this transaction has what we call commercial substance. And I'll talk a little bit more about what that means and show you an example with and without commercial substance on Sunday. But we'll assume that exchange has commercial substance. And commercial substance very basically just means that our future cash flows will change as a result of this transaction, that we're getting equipment that is in some way, shape, or form changing the cash flows of my business. It's a better operating machine. It's going to operate for longer years, produces better units, whatever story you want to make up. It has commercial substance. It'll alter the company's future cash flows. We recognize the full gain in that case. And we have gains are always credited. Gain on exchange is definitely going to be recorded because of the commercial substance, $4,000. Now, other things I can record. I'm giving up equipment with a historical cost of 50,000. That means that I would be crediting my equipment account by $50,000. This is the item I'm giving up. I also have to get rid of the accumulated depreciation associated with that equipment, because once that equipment account's gone, then this accumulated depreciation needs to go with it because it was just the contra account to this parent account. So both of those leave my company's ledgers. I am going to recognize some new equipment because I got new equipment. But before I value that, I also take into account that we received $1,500 cash. And so I just keep building it account by account until I've run out of things to recognize in this transaction. And I always leave this last value, what we got, in exchange for, to be my plug value for the journal entry. So I have $54,000 of credit here. I have $36,500 of debits here. So the difference between those two gives me the value of my new asset. And the value of my new asset is $8,500. Or wait, sorry. It's $18,500, I believe. Let me do that math real quick. I put in 45,000 instead of the appropriate amount. $17,500. When you solve for the missing debit amount, this is 54. And then you just plug to figure out what that has to be. I entered it as 45 when I initially did the 7,500 or whatever the heck I did the first time. And does this make sense? Does it make sense that I'm valuing the new equipment at that amount? It does, because what did I give up? Well, I gave up equipment of $19,000 value, $19,000. That's its fair value. So I gave up that, and I received $1,500. So if I gave up something worth $19,000 and also received $1,500, then it only makes sense that what else I received makes up the difference between those two amounts. because basically they're saying, oh, we're taking your $19,000 piece of equipment and we're going to give you our piece of equipment, but in order to make this trade worth your while, I also have to give you 1,500. So theirs must be worth 1,500 less than what I gave them. So we'll talk about this a little bit more and just talk about the role commercial substance has in recording gains and losses. It has no impact on recording a loss, but it can affect whether we're recording a gain. In this case, even if we didn't have commercial substance, we would have recognized a portion of the gain because we received cash as part of the exchange. But I'll finish that up on Sunday and also get into some interest capitalization and also R&D on Sunday, tomorrow. Thank you guys for coming. And I wish you a great Saturday.